All right, welcome back. The valuations are deemed a bit rich, right? Especially in that tech sector, like the Magnificent Seven. And we've had a historic run off the lows of April 8th with virtually no significant pullback, right? And with stocks at all-time record highs, what's an investor to do now, right? Do we chase these highs and add more purchases to our portfolios? Or do we wait for a pullback and put more money to work, right? These are common sense questions that I get all the time, and I think they deserve common sense answers. We know just the man for that. Please welcome to the show, Mr. Keith Fitz-Gerald. Keith, thanks for taking the time. You might even get these questions. Hey, is it still the right thing to do to keep chasing these markets higher? What say you?
Well, you've got to be very choice. You've got to be careful with your words when you choose to invest, right? Chasing something because you want to chase it is never a good bet. Go chase rabbits if that's what you want to do. If you want to invest logically, if you want to move the money into the markets where you know it can build wealth, that's a different proposition. What we encourage people to do at moments like the present is change up their tactics. You've still got to have a toe in the water because this market could go a lot higher. If you sit and you tell yourself you're going to wait for a pullback, you may be waiting, as a lot of people are, for a pullback that never happens.
So you're right, because, I don't know if it's still $7 trillion, but the numbers were after that April 8th lows when people voted with their politics and got out of the market altogether. There's $7 trillion that still has yet to come back into that market. And as we get closer and closer to the end of the year, that window gets a little tight and things get a little uncomfortable, right? Because you've got some splaining to do, Lucy, to a lot of your customers that you haven't really given them a return on the money that they would be expecting. So are you I guess you're trying to tell us to be smart about what you're buying. Don't chase. If there is a time to take a little bit of a pullback, put some money in. But we really haven't had a wholesale pullback across the market here to get people to get off the sidelines and put some money to work, though, have we?
No, and here's the interesting thing about that. There's actually 7.4 trillion is the figure that we heard and saw. So, the odds are very good that you may not actually get a meaningful pullback in the classic sense of the term. So something as simple, Scott, for most investors out there, something as simple as dollar cost averaging. Now, a lot of people hear that and they roll their eyeballs and thinking, that's what grandma does. Well, they're right. Grandma does it because it works, right? But the key, what people must misunderstand when it comes to a market like this and a tactic like that, is that it's not just buying on dips. That's not dollar cost averaging. Dollar cost averaging is taking an equal amount of money and you commit it to the markets on schedule, regularly, rain or shine, and keeping your emotions out of the equation. Because what history shows beyond any shadow of a doubt, and I'm talking hundreds of years of market history now here, all over the world, thousands potentially, is that is how you beat Wall Street at its own game, because you take the volatility they're using as a weapon against you as an individual investor, and you flip those odds to your side of the table, take it off the plate, and in fact continue to buy the world's best companies. Over time, that's going to be your friend and your secret weapon.
It's not uncommon. Well, I guess it's not an accident that the smartest people on the show a lot of times say the smartest thing. You and Nancy Tengler have been really kind of saying the same thing here. If you go back 100 years, maybe 150 years to the Dow Jones in the early 1900s, yes, valuations were high. Yes, they had there was too much in a few certain railroad companies or a few certain other companies. Yes, there was a lot of market saturation in the quote unquote like the Magnificent Seven we see today. But the market sorts it out going on, and had you stayed in, you'd be just fine. So I like the message is be smart, don't be stupid, don't chase just to chase, like you said, rabbits. But also realize that this isn't new. The market's been through this before. And if you just do your homework and invest in the right things, that should be okay, right?
Well, yes. And what I'm about to say is financial heresy to the valuation crowd, but there are plenty of examples in history where valuations have been sky high. Amazon, for example, in the early 90s or late 90s, I guess it was 100x. And it's a $2 trillion company today, or multi-trillion-dollar company today. Apple, same thing. NVIDIA in 2022 was 65x forward earnings. 2025 actuals were 12. So you look at a company like this. It's one thing if you're talking about plow blades, car parts, car doors, manufacturing tools, whatever, but completely a different animal if you're talking about digital investments operating in real time in a digital world. So you want to buy the world's best companies. You don't want to buy yesterday's companies. And you don't want to think about them using yesterday's tactics, but expect different results. It makes no sense.
And I just want to make sure everybody understands that when we talk about 100 times earnings, price is 100 times 100 times earnings, right? And that is what we a lot of folks use as a benchmark in the investing world. But you know what we talk about also, and this you can grow into those earnings, right? Is if you're still making a lot of money and you continue to make more. And I think that's something that we've seen, say, for instance, like NVIDIA, you just mentioned.
Well, again, the biggest risk here is not buying in too expensively. It's under investing. And the reason I say that is because, again, another lesson from history, learned the hard way, I've got the scars and the decades to prove it, is that missing opportunity is always more expensive than trying to avoid risks you can't control, especially when it comes to valuation.
All right, now I have the bunch. This is totally left field, and I apologize. I didn't even let you know I was going to ask you about this. But, you know, Jeff Bezos talking about energy and running these data centers, he mentioned that he was going to float some stuff up into space with some solar panels on it because you get 24/7 sun up there, and he thinks that there's going to be, data center power things in space, just like we have weather things in space to start to get all that energy to run some of these big data centers with AI. What do you think about that?
I think that's a very interesting idea. I hadn't heard about it, but you know what? That doesn't surprise me. And I think it's probably the next logical extension. The key in my mind is if we're going to do that, we have to figure out how to get that from space to the power plants and transmission lines here on Earth, right? The terrestrial variety. But there's no question we're going to need more energy. So how do we get there? What does that look like? I think it's going to involve innovative thinking that many people regard as discombobulated or absurd. But you know what? Profits are always found at the edge of absurdity when you're talking about new technology. Always. So good on him if he can pull it off.
Profits are always found at the edge of absurdity. That's awesome. I'm gonna leave on that one, Keith. Always great to have you on. You got a big fan base here. Keith Fitz-Gerald coming to us all the way from Seattle, Washington.